Let's move on to Marvell. This is one of the highest risk reward plays in the portfolio, but they've got some key partnerships, and we've talked about how much those key partnerships are spending, particularly Amazon and Microsoft. Can you talk to me a little bit about Marvell today and how they compare to other players in this space?
Yeah, if you were gonna bum me out with the Amazon tee up, Marvell, woof. Broadly speaking, the most disappointing stock in the portfolio. So I think it's worth an update, and they actually had some specific news this week, so we'll cover both. Now, as background for anyone listening, especially if you're newer, there is an opportunity around custom chips because you've got NVIDIA supplying record-breaking amounts of GPUs. The alternative for companies like an Amazon or a Google or a Microsoft is to build your own custom chips designed for AI workloads that not only gives you a differentiation factor where you can be cheaper than competitors, but it also allows you to have some leverage over NVIDIA in negotiations. So it makes a lot of sense why these companies will want custom chip programs. Now, Broadcom has soared to being worth 1.4 trillion with major partnerships with companies like Meta and Google, which is their best partnership, and OpenAI. Marvell, the bull case for them is they have partnerships with Microsoft and Amazon, but they're worth 70 billion, so about 20 times less. In addition, they have a pretty strong portfolio of all these connectivity products, things like digital signal processors and being able to connect different data centers together. So here's the news for them this week. A Wall Street firm crunched the numbers on their deal with Microsoft, and they found it will deliver, in their estimation, 2.4 billion in revenue to Marvell in 2026 and 10 to 12 billion in 2027. For perspective, Austin, right now Wall Street expects Marvell as an entire company to generate 9.8 billion. So this one chip, this one product would be bigger than the entire current expectations. Putting this into an earnings perspective, right now Wall Street expects somewhere in the neighborhood of $4 in profits in 2027. This could take Marvell up past $8 to $10. So potentially 150% greater than Wall Street expectations. And I should note, if you're looking at $10 per share, what's the company trading for today? Slightly more than $70 per share. That means 7 times earnings for some of the highest growth in the portfolio. Austin, it sounds like a slam dunk. We should be backing up the truck, putting every single dollar we have into this stock. So why are we not? Right? That is the question.
Portfolio management. You're about to explain why even a perfect narrative sometimes doesn't unfold. What's
Doesn't
going
always
on?
work.
Why did you limit the position size
Well,
here?
Austin, the big thing is Marvell, the morning after this news broke, was up 11%, as you'd expect. And I said to some people who had asked me about it, I said, I bet these gains are gone within a few days. And you know what? As of this morning, they're gone within a few days. And go ahead.
I'll put the actual numbers out there. The day the news broke, Marvell was trading for 76.45 a share. Today, at the time of this recording, it's 76.20.
Yep.
So there you go. Exactly nailed
Yep.
it.
And the reason for this is Marvell had hosted an analyst day. They gave outlook and figures that basically, if you put them into a model, you have found they were set to crush Wall Street expectations. They jumped and it all fluttered away within a few days. And we just see this process happening over and over again with this company. The biggest reason also is just Marvell's been kind of a serial underperformer across time. They have this amazing opportunity that in some ways they've kind of lucked into, but there's an incredible amount of whispering about them performing very poorly in a lot of their portfolio and kind of the broader networking and connectivity space. And also there's always going to be risks that they have to execute. They have this deal with Microsoft, but Microsoft is trying to hedge its bets and working with other firms to try and develop chips. Will they actually get this to market? So Austin, it seems like Marvell for now is kind of star-crossed. It has the potential to rise 2-3x from where it's at today if it can fulfill on these deals, but it's going to need to execute on them. And until we see that execution happening, the street's not going to re-rate it the same way it has Broadcom, which has executed. So when it comes to Marvell, most disappointing stock in the portfolio. Fine with GitLab for that, but most disappointing stock. It's a battleground stock. we're going to leave as is despite the potential. And like I said, it is high risk, high reward. So if anyone's been looking at Marvell saying, hey, when you talked about that stock with the deal with Amazon, it sure sounded cool and it seems to be going well. What's going on? This is what's going on. And that's about the best summary I can give on Marvell.
You know, Eric, you're going to hate me for this
Oh, great.
analogy, and I'm going to put you on the spot with a little bit of a question. But when I hear about a very promising domestic chip maker with execution risks and a serial underperformer, be forgiven for thinking you were talking about Intel instead of Marvell, right? So I'm wondering when you see companies like Marvell, and let's just throw Intel in there as well, where there is a major movement to bring manufacturing back to the US. AI is this multi-billion-dollar race, and there's a lot of capital that's going to be flooding through there. And you and I have referenced the book Chip War in the past and just how much domestic government or federal investment set the US chip industry on an incredible multi-decade trajectory. Feels like we might be at a similar moment where there's a lot of domestic, major infrastructure spend. Is it worth, and we're not going to do this in the portfolio, I'm sure, but is it worth investors considering like some call options on a Marvell or some call options on an Intel? Very low percent of your portfolio, but these companies that are domestic champions, serial underperformers that need a lifesaver. But if they get one, they'll re-rate very quickly. Is that a way to play
I feel
these?
like you're setting me up here. You're setting me up, Austin. Yeah, I own call options on Marvell, in part because of this kind of optionality, where if these contracts do play out, they will be worth significantly more, and if not, in some ways it feels a little superior to buying the shares. Of course, that's dependent on how aggressively options are priced. But no, that probably is if you were purchasing it today, the superior play, and it just comes down to timing. Will they re-rate by the time your options expire? So if you're doing that, you'd probably want to look out to 2027 in January, because you're gonna, know it's hard to get an advantage on Marvell in any short term because it is moving entirely on supply chain chatter. And that's an area where a lot of these pods and these big hedge funds have an advantage, and it's a place where the individual investor has no advantage. So, if you're holding on a thesis over a few years, you might be able to do relatively well. But if you are trying to trade the stock in the short term, it's not going to go well for you.
Well, yeah, I promised to our listeners, I actually did not know that you held call options. So a convenient sleuthing there, but that's where my mind went.